If you thought the global supply chain was finally getting back to normal, think again. A new report shows that supply chain sentiment dropped sharply in March, sending fresh waves of concern through the trade and logistics world. But this isn't just a business headline. It affects everything from what's on store shelves to how much you're paying for everyday goods. So, what's behind this sudden shift? Are we heading back to the chaos of 2021, or is this something new? In today's video, we're unpacking why sentiment is falling, what it means for businesses and consumers alike, and where the global economy might be headed next. If you care about prices, jobs, or global trade, you'll want to stick around for this one. And if you find value in these breakdowns, give this video a thumbs up, subscribe to US Trade and Tariff Watch, and drop a comment with your thoughts. It really helps keep the channel going. Let's get into it. What is supply chain sentiment? Supply chain sentiment is essentially a measure of confidence. It reflects how optimistic or pessimistic companies are about the flow of goods, production timelines, delivery schedules, and future demand. When sentiment is high, it usually means businesses are confident. They're ordering more, hiring more, and expecting steady or growing demand. But when sentiment drops, it sends a signal, a red flag. It means companies are feeling uncertain. Maybe about the economy, maybe about labor shortages, or even geopolitical risks. Think of it like consumer confidence, but for manufacturers, shippers, and retailers. It's not just about feelings, it's about data, orders, inventory levels, and production forecasts. A major drop in sentiment often precedes slower growth, reduced spending, and supply chain disruptions. So when experts say sentiment just fell hard in March, it's not something to brush off. It's a potential preview of what's coming down the road. March decline. What happened? According to the latest analysis from Global Trade magazine, supply chain sentiment in March dropped more sharply than at any time in the past year. The report pulls data from surveys across industries, logistics, manufacturing, retail, and distribution, and the mood is clear: uncertainty is back. Several factors triggered this shift. First, there's growing anxiety over rising input costs. From raw materials to shipping rates, businesses are once again seeing price pressures that had temporarily eased last year. Second, shipping delays and bottlenecks are starting to creep back into the picture. While not nearly as severe as during the pandemic, ongoing port congestion, especially in key global hubs, is causing enough friction to rattle operations. Third, there's a noticeable cool-down in consumer demand, especially in durable goods and discretionary spending categories. When consumer demand softens, companies scale back inventory orders, and sentiment naturally drops with it. The combination of rising costs, operational hiccups, and demand uncertainty created a perfect storm in March. And the report's tone suggests that this isn't just a short-term blip, it could be the start of a broader shift. The sharp decline in supply chain sentiment doesn't just stay within boardrooms and cargo ships, it ripples outward, affecting almost every player in the economy. For manufacturers, a drop in sentiment often leads to production cuts or delayed capital investments. When confidence falls, companies hold back. They reduce orders for components, pause automation upgrades, and reassess supplier contracts. Retailers start to tighten inventory levels. Instead of stocking up, they move toward just-in-time inventory again, trying to avoid the risk of being stuck with unsold goods. This can lead to leaner store shelves and more out-of-stock signs, especially for seasonal or specialty items. Logistics providers, trucking firms, warehouse operators, freight forwarders feel the squeeze too. When shipments slow down, so does their revenue. Lower demand for transportation services can lead to rate drops, underutilized fleets, and even layoffs in extreme cases. Even consumers will feel it, not necessarily because products disappear overnight, but because shifts in the supply chain often translate into price volatility, longer delivery times, or fewer options at checkout. In short, when sentiment drops, everyone feels the tremors, whether they realize it or not. Why this matters globally? Supply chains don't operate in a vacuum, they're the lifeblood of the global economy. So when sentiment drops in one region or industry, it can set off a chain reaction across continents. Many US businesses, for example, depend on suppliers in Asia, Europe, and Latin America. If sentiment is weakening in the US, foreign suppliers may start slowing down production, cutting hours, or diverting exports elsewhere. That can disrupt the flow of goods globally, from automotive parts in Mexico to semiconductors in Taiwan. Markets also respond to these changes. Declining sentiment often precedes slowdowns in trade volumes, which in turn can affect global GDP growth, equity markets, and commodity prices. Investors watch sentiment reports closely because they often signal where economies are heading next, long before the official data arrives. And let's not forget geopolitics. A fragile global supply chain can make countries more vulnerable to shocks, like war, trade disputes, or natural disasters. The less confidence there is, the harder it becomes to respond to those crises effectively. Bottom line, a drop in sentiment is more than a mood shift. It's a warning signal for the entire global system. Historical comparison. Is this worse than 2020 or 2022? To really understand what's happening now, it helps to look back. The world saw unprecedented supply chain disruption in 2020 during the height of the COVID-19 pandemic. Ports were clogged, factories shut down, and entire sectors ground to a halt. That was a crisis driven by shock, a sudden halt to the global system. Then in 2022 we had a different kind of disruption, the post-pandemic whiplash. Demand surged, but the infrastructure couldn't keep up. Labor shortages, container shortages, and inflation drove chaos across the board. That period marked the peak of supply chain stress, but it also triggered huge investments in resilience. Fast forward to now, March 2025. This time, the concern isn't about overwhelming demand or once-in-a-century shutdowns. It's more subtle, and maybe more dangerous. Confidence is eroding, even as operations technically remain stable. Businesses are pulling back not because they're forced to, but because they're nervous about what's coming. That's what makes this drop in sentiment especially troubling. It's not fueled by a specific event, it's a signal of broader uncertainty. And when companies start preparing for the worst, that caution can become a self-fulfilling slowdown. What's driving the decline? So, what's behind this sharp drop in supply chain sentiment? According to the Global Trade Magazine report and supporting industry insights, it's not just one thing. It's a convergence of pressures that's wearing down confidence. First up, inflation. While overall inflation has cooled compared to its 2022 peak, input costs are creeping back up. Energy prices are volatile, raw materials are more expensive, and shipping rates, especially on trans-Pacific routes, are on the rise again. These cost increases eat into margins and make future planning harder. Next is the labor challenge. Warehouses, truck fleets, and manufacturing facilities are still dealing with staffing issues. There's also geopolitical tension. From ongoing instability in Eastern Europe to growing trade friction between the US and China, the global trade environment feels anything but stable. Even the threat of new tariffs or sanctions can send shockwaves through procurement and logistics networks. Add to that a softening in consumer demand, especially in categories like electronics, home goods, and apparel, and you've got a cocktail of caution. When companies sense a slowdown, they naturally shift to defense mode. That means fewer orders, delayed expansion plans, and less confidence in the months ahead. Altogether, it's a complex web of economic, operational, and geopolitical uncertainty, and it's weighing down the entire supply chain mindset. With confidence falling and caution rising, what's next for the supply chain world? Industry experts suggest we could be heading into a period of strategic slowdown. This doesn't necessarily mean a full-blown recession or crisis, but it does mean that businesses will be playing it safe for the next few months. Expect to see more companies reducing bulk orders, delaying infrastructure investments, reevaluating supplier relationships, and keeping inventories leaner than usual. This conservative approach can help businesses weather short-term instability, but it also has consequences. If everyone pulls back at the same time, it can trigger a broader economic cooldown that spreads beyond supply chains into jobs, investment, and growth. On the positive side, this could also push companies to double down on resilience. Some firms may start investing more in automation, regional sourcing, and AI-powered logistics platforms to gain better visibility and flexibility. In other words, downturns often lead to smarter strategies in the long run. But in the short term, expect more headlines about shipping slowdowns, delayed deliveries, and cautious forecasts. The mood for the second quarter is already being described as fragile, and sentiment indicators will be closely watched moving forward. What you can do. For importers, small businesses, and consumers. If you're in the trade world, importer, distributor, or small manufacturer, now's the time to double-check your supply chain strategy. Here are some smart moves. Diversify suppliers. Don't rely on a single region or vendor. Negotiate flexible contracts. Lock in pricing where possible, but leave room for adjustments. Monitor lead times closely. Stay ahead of delays by building buffer time into your logistics calendar. For small businesses and retailers, this is a good moment to audit inventory levels. Keep stock lean, but make sure you're prepared for demand spikes, especially around seasonal cycles. And don't forget to watch freight costs. They may rise again before summer. Even as a consumer, it's helpful to be aware. If you're noticing price fluctuations or shipping delays, it's not random. It's part of a larger trend. Buying early and avoiding last-minute orders can help you stay ahead. No matter where you sit in the economy, understanding these signals gives you a head start. The sharp drop in supply chain sentiment this March isn't just another blip on a chart. It's a signal, a warning. It tells us that behind the scenes, businesses are getting nervous, supply lines are tightening, and the road ahead might be bumpier than expected. Whether you're a company sourcing goods globally, or a consumer wondering why prices are creeping up again, this shift affects you. The key takeaway? Stay informed, stay prepared, and don't assume the supply chain issues of the past are fully behind us. The system may be more stable than in 2020, but the confidence that keeps it humming smoothly, that's slipping. And that's something we all need to watch. Thanks for sticking with us. If you found this video helpful, hit the like button, subscribe to US Trade and Tariff Watch, and drop a comment below. We'd love to hear your thoughts on the current supply chain mood. Sources are listed in the description, including the full report from Global Trade magazine and supporting data from industry analysts. We'll see you in the next